Why being poor is surprisingly expensive. Imagine two people walk into a bank. One has £1 million in investments, the other has £50 left until payday. Who do you think gets the better deal? The millionaire. Lower interest rates, better credit offers, exclusive rewards, free financial advice, sometimes even free meals and event invitations. The person who actually needs help the least gets the most benefits. Meanwhile, the person struggling to make ends meet often pays extra for everything: higher loan rates, higher insurance premium, higher banking fees, more penalties, more interest, more risk. It's one of the strangest realities of modern life. The less money you have, the more expensive life becomes. And once you see it, you'll notice it everywhere. The boot theory. There's a famous idea called the boot theory. It comes from a fantasy novel, but economists and financial experts reference it all the time. The idea is simple. A wealthy person buys a pair of high quality boots for £100. They last 10 years. A poor person can only afford a £20 pair. They wear out after a year. Over 10 years, the wealthy person spends £100. The poor person spends £200. The person with less money ends up paying more, not because they made a bad decision, but because they didn't have the option to make the cheaper long-term decision. And this pattern repeats throughout life. The loan trap. Let's say your car breaks down. You need £5,000 fast. If you have excellent credit, banks compete for your business. You might get a loan at 5%, maybe even less. But if your credit score is lower, that same loan might come with a double-digit interest rate. Suddenly, you're paying hundreds or thousands more for the exact same amount of money. Think about that. The person with the least financial flexibility gets charged the most for borrowing. The person with the most financial stability gets rewarded. Money somehow makes borrowing money cheaper. The credit score paradox. Here's where things get even stranger. Many companies don't just look at how much money you have. They look at how risky they think you are. And risk changes prices. A person with a high credit score often gets better rates on loans, better rates on credit cards, sometimes better insurance pricing, better mortgage offers. It's not because the service costs less to provide, it's because companies believe they are less likely to lose money. The results? The people who need affordable financing the most often face the highest costs. Why your neighborhood can cost you money. Now let's talk about something that surprises a lot of people. Your postcode. Your neighborhood can affect how much you pay for car insurance. Two people could drive the exact same car, have similar driving records, be the same age, yet one pays significantly more. Why? Because insurers look at historical data. How many accidents happen in the area? How many thefts? How many claims? How much fraud? If your neighborhood generates more claims, premiums often rise. Even if you've never had an accident yourself, you can be an excellent driver, but your surrounding can still affect your bill. The same thing can happen with home insurance. Where you live influences what you pay, sometimes dramatically. Paying more because you can't pay up front. Here's another hidden cost: monthly payments. Imagine a service costs £1,200 per year. If you can afford to pay the full amount today, that's it. £1,200 done. But many people can't, so they pay monthly. And monthly often comes with financing charges, interest, administrative fees, extra costs. The exact same product becomes more expensive simply because someone couldn't afford the larger upfront payment. The cheaper option required having more money. Banking isn't always equal. Many premium banking customers receive perks: dedicated support lines, higher savings rates, exclusive products, airport lounge access, investment advice, relationship managers. Meanwhile, people with smaller balances may face overdraft charges, maintenance fees, and fewer benefits. Again, the pattern appears. The customers bringing the most money receive the best treatment. The customers struggling the most often face the highest penalties. Time is money too. Rich people aren't just saving money, they are often saving time. They can pay for convenience, food delivery, professional services, accountants, cleaners, financial advisors, lawyers, virtual assistants. The less time they spend solving everyday problems, the more time they can spend earning money. Meanwhile, someone with fewer resources may spend hours comparing prices, dealing with paperwork, waiting on hold, or commuting longer distances to save a few pounds. Time becomes another hidden expense. The compounding effect. Here's the real problem. None of these costs exist in isolation. They stack. A higher loan payment, a higher insurance premium, more fees, more interest, more replacement purchases, more financial stress. Each expense makes it harder to build savings. And without savings, it's harder to access the cheaper options available to people with money. It's a cycle that can feed itself for years, sometimes decades. The important caveat. Now, this doesn't mean companies are secretly trying to punish poor people. Most businesses are responding to incentives. Banks price risk, insurers price claims, lenders price default probabilities. From their perspective, they are making statistical decisions. The issue is that those statistical decisions can create outcomes that feel deeply unfair on an individual level, especially for people who are already struggling. Conclusion. We often hear that money can't buy happiness. Maybe, but money can buy cheaper loans, cheaper insurance, better banking products, higher quality goods, more convenience, more time, and sometimes that's the real advantage. The biggest financial benefits of having money isn't what you can buy, it's what you no longer have to pay extra for. And that's one of the most counterintuitive truths about the modern economy. Being rich is expensive, but being poor can be even more expensive.